too many founders think the only way to build a business is for exit, which requires VC backed. But there's lots of beautiful businesses, even 5 to 10 million revenue with double-digit profitability, churning out some nice annual cash per year where you can be really happy as a founder and have a really great community and a great business without going down that path.
Welcome to the next episode of the Beauty the Brand podcast. I'm here with Dominique Gagnon, a brand builder and award-winning innovator and growth strategist. Dominique helped found category-creating health and wellness brands like DEINDE, Caldera Lab, and isbel&co. Through future-forward strategy, seasoned R&D leadership, and team stewardship, Dominique advises investors and startup founders in crafting brands that deliver breakthrough consumer product experiences. She's also been featured in Beauty Matter, Future 50, New Beauty, and B100, Independent Beauty Association Indie Beauty Innovators Award, which is incredible. Your accolades are stacked. So welcome, Dominique. So excited to have you here. We had such a great conversation last time when we connected one-on-one that I was like, we have to bring this onto the podcast because I come from the side of like bootstrapping, self-funded brands. Like all of our founders, majority of our founders are bootstrapped, self-funded. I myself, as a brand founder, was also bootstrapped and self-funded. And Dominique comes from the completely other side. And I do know I have founders that are interested in what does it even look like to get funded? What is that process like? Is it something that I want to consider? And they may be considering it. And so I really wanted to bring this topic forward, and you're the perfect person to do it.
Oh, well, thank you. Yes, it was such an interesting back and forth. I've been so head down in sort of the VC-backed world and thinking about managing investors. And you were chatting about what it means to bootstrapped and bootstrap founders thinking about investment, that it really is two different worlds. It's really building two very different businesses.
100%. So let's dive in. So tell me, you worked with multiple brands that have gone after big retailers like Sephora. How does retail presence play into the funding or acquisition conversation, and does it?
Very much so. It's one of the critical variables investors look for starting at seed. So my background is really in the early stage companies, sort of 0 to 10 million, which we're typically talking seed, Series A, Series B. Investors, basically their valuation models will give you a huge spike in valuation if you have even a retail contract signed you haven't entered yet. Critical for Series A, and then even in seed, the conversation is typically around, are you thinking about retail? What's your long-term strategy? They want to know you're setting up the brand to get into retail if you haven't yet already.
Okay, I want to know why. And here's why. I'm thinking about it from the perspective of like margins, profitability, wholesale's like always up and down. Like talk to me why that's still the case.
Yeah, I think it's investors, even early stage investors, are thinking about the return they'll get, which is based on sort of a cycle or a pathway, more specifically, to acquisition and exit. So if you're seed, you're thinking, is the next person down the line going to invest in this company? Is the next person, and is that going to lead to exit? If you're talking about a brand that a L'Oreal, a P&G, a Unilever will want to acquire, which is the traditional exit versus IPO in beauty, then they need to have retail distribution. That's where you get basically the majority of revenue at that kind of global scale of brand. So I will just say, I think too many founders think the only way to build a business is for exit, which requires VC backed. But there's lots of beautiful businesses, even 5 to 10 million revenue with double-digit profitability, churning out some nice annual cash per year where you can be really happy as a founder and have a really great community and a great business without going down that path. So, but that is, if you are talking to investors, they are thinking about that standard pathway. And definitely once we talk Series B, Series C, the next way to get a high valuation a few years down the line and keep it going down that path is through retail.
Even with all the sort of closures of stores and restructuring and with department stores, et cetera, like even with that in mind.
It's been interesting because I'm going to age myself. I'm mid-40s. When I got trained as a brand manager, we were talking about trial and repeat, and it was all store. It was pre-internet. And now the world is different. And I watched department stores, the majority of them, clothes, and we're in a different landscape of retail, but still within beauty, that footprint, the majority of sales happen in retail. We have seen brands like Medicate, which was a L'Oreal acquisition recently. They started in the professional channel, very much a clinical brand. But when private equity got involved, they diversified the retail strategy, and then they were primed for acquisition. But I have not seen a brand not in some point of retail, whether professional, department, or beauty retail, get acquired. So it really is just a proof point. And even with, you are right, you're not close to your consumer as you are in D2C. You're getting a hit on margin. There's a lot of cost of doing business. Sephora is very well known for getting involved in your product portfolio growth strategy and how your product is basically designed. But it is sort of a requirement to get in front of consumers where they shop at that scale. I will say I've been watching the rise of Amazon Beauty. I'm waiting for the day a brand that's been primarily built on D2C and Amazon Beauty makes it to some sort of exit without going traditional brick and mortar retail.
So one of our brands, one of the early first brands that I worked with inside our C2C community, ended up selling her hair care line to Perch, which is like an Amazon investor. So yeah, that was like one of the first exits we've experienced. But I agree. Like, I wonder what that will look like. What will the ecosystem look like as we see brands grow up on Amazon and some of these other verticals?
Yeah, and I think this is one of the difficulties of having this conversation, because everyone, like myself, wants to give great broad advice, but a broad advice does not really reflect the reality of the investment landscape. It really is like dating, where there's so many different varieties of investors. What they're looking for is different, how they manage their portfolio, how they're thinking about ROI. So when I talk right now about kind of the standard landscape, it really is the majority or the main players in beauty. It doesn't cover everyone.
And who are the main players? Because I know our listeners are probably wondering, like, well, talk to me about, like, who are the main players? What should I be looking for in terms of a good partner?
Yeah. So you have some classic names that have fantastic portfolios that are always discussed. True Beauty Ventures, Sandbridge, Unilever Ventures. There's going to be the folks who show up at Dealmaker Summit in July every year, the main players in beauty. So I think a lot of people kind of follow the metrics that they look at, how they talk about their brands, who they're taking in their latest cohort or their latest investment very, very seriously. But I will say I have seen a lot of brands do different routes, like it sounds like you have as well. One of the last brands I built or helped build, Caldera Lab, the first premium botanical line for men, is about to hit 40 million this year, closed a Series A with Mark Bezos, family, High Post Capital, family investment, family funds, family firms, much more patient capital, very different profile. Obviously, that's tied to the e-commerce world, very different growth path. So there's more diverse opportunities. But if you want to talk the major players, we are talking like the ones I referenced that just have really robust, beautiful portfolios in beauty.
Okay, so I know our listeners are probably going to be wondering, okay, talk to me about family funds versus more traditional investors and sort of what the difference is between the two.
So in the venture capital world, a venture capital firm is really someone in finance who chooses to raise a round from LPs, limited partners, which may include family firms, could also include educational institutions, banks, anyone with major assets. They typically have a very specific scope for what they invest in, and they are very clear up front. If you're approaching a VC, you should know their scope. That's what size of check do they write? Do they lead around or follow around? What category do they invest in? So you might have a firm who says, I write checks of 100K, or I only write checks of 1 million above. Series A rounds, or no, don't talk to me until Series C. and I will never lead you around, but I like writing secondary checks. And that is really how they profile themselves. And they are looking to maximize when they raise a fund from their LPs, maximize the return. So they're looking, so you should keep your eyes on when a VC raises a new fund, because then they're looking for that 8 to 12 or 5 to 10 investments that will be the weight and brunt of that fund and deliver returns.
So two follow-up questions, but one is like, how do they just recently raise a fund? How do you know they're looking to invest?
So this is one of the things, like my biggest advice would be, if you want to go down the VC path and you think you're building a business for that major exit, which requires typically VC investment, then like dating, you can't wait until you're ready to get married at 33 and say, I'm going to meet the man of my dreams tomorrow. You need to start dating early. So unfortunately, thinking about investment for your company is an allocation of time towards networking, towards going to conferences, not when you're looking for money. When you're looking for money is kind of the worst time. Even if you find the perfect investor, which we all know in dating is finding the perfect partner is difficult to do, they know you're desperate. And I've actually seen, this was in the biotechnology world, which I was in beauty biotech at my last company, them squeeze the financing, the deal terms, because they like a 3-month burn rate to run out of cash. So yeah, it was heartbreaking to watch. I mean, any entrepreneur feels for other entrepreneurs, even if you want to win personally. So really, I think you need to start networking early, having conversations early. And I will say, if you're well posed on LinkedIn, if you're doing PR for your own company, VCs typically have their own scouting processes. So you should be getting inbound from early days. If you have a win on LinkedIn that you're marketing on LinkedIn, you may be getting inbound. Hey, I'm XYZ, would love to have a chat. Make time.
Interesting. Okay, so if it's something that you might be entertaining, make time for it. Don't wait till the last moment.
Yeah. And I would be thinking, if it was me and I was starting a business tomorrow and I was planning to bootstrap for 2 years until I had the foundations done, and then might consider the VC path if the business proved out, I would be thinking about going to Dealmaker Summit. I would be allocating time per week to talking to friends who are their investors. Can I meet with them? Can I have a coffee? And really start to find who's the right fit. Because like I said, everyone is different. And even if you find someone who's the perfect fit, I know I'm doing a 1.5 million seed round in a year. They're in my space, their portfolio is equivalent, and they lead rounds, which you obviously want. They may say, we just, in our beauty portfolio, we've been focused on fragrance and you're a fragrance brand, and we're shifting body. Like what I really want to focus on is body. And it just, your timing is off, just like in dating. So it really does take time to start to have conversations, and investors are used to it. They will say, keep in touch. And, they will be very honest on the phone or on a call. You may be a right fit. Your metrics are a little lower, which you already knew going in. Contact me again in 6 months. Keep me posted on the business.
I literally have written down like 5 questions. Okay, circling back to something you said lead around or follow around. What is the difference?
Yeah. So when you do any from seed to Series A to Series B on round of VC financing, you need someone. It's like if you're putting together a contract for an agency you're working with, one of you guys has to put the draft contract together. So a lead investor is the first person who puts a contract on the table, which is called a term sheet. That's the terms for how you're priced and anything else, caps, like all of the details of how the financing and the negotiation happens only with the lead. The followers come in agreeing to those deal terms. And so when typically in investment strategy, when you're thinking about your path to fundraising, you are thinking about both finding a lead and then finding a group to follow at those deal terms to make up the rest of the round is the language.
Makes total sense. Okay. And then you kind of answered this, but in terms of like how much time it takes so from obviously the advice is like, take those meetings, right? Keep continuing the conversation. If there's an opportunity, make time for the meeting, reach out to people that you could help you set up that meeting, right? But typically, how much time does it take from, let's say you're going hardcore focus on pitching to kind of closing around, like what is the kind of the average time frame?
Yeah. And everyone asks because you as a founder are allocating over 50% of your time if you're raising to the raise. So things have been difficult over the last year for broader reasons we all understand. But before that, it would take on average 6 months. You may be moving really speedily and get it done in 3. I've seen some take 8 to 9, but on average, I would say 6 months is a healthy time to say, if I start raising in February, it will be done 6 months from then. That's my target date. I'm really looking then to allocate the majority of my time on that period to the fundraising, to all the meetings, to flying everywhere, to closing that round. And my team has to reorganize around that. The other Actually, you didn't ask this, but I will highlight there's good times a year and bad times a year to raise. So you really don't want to start raising in like September, October, because the holidays come, everyone gets swept away by that, and you don't get the momentum. So typically you see people kick off right after the holidays, January, and look to close by the summer or maybe to fall. But really think about the kind of, there is momentum. We are all human, investors included, to I've got a lead, I'm coming back to you. But if you're in August in Italy and the momentum drops in the round and someone calls you back and said, did you get that remaining 500K you needed to close the round, and you haven't, things really straggle. So you have to time your raise around when you'll get accessibility to the investors.
Okay, that makes sense. That makes total sense. That's great. Great to know. You mentioned bootstrapping the first 2 years. Typically, what sort of metrics are you looking to reach as a bootstrapping brand in order to be ready and desirable for funding?
For funding, and I think if we're talking about a significant seed, or if you had a lower kind of bootstrapped investment and then you're looking to target then a Series A, we're talking revenues, number one, and we're talking in the millions, double-digit growth. CAC to LTV is a very important metric, which combines a lot. It combines your marketing acquisition cost with your contribution margin, what you're getting on the LTV side per order per sale, and your retention rate, which is really important. They're going to look then at your cash burn rate, which is connected to profitability. Basically, for that revenue, how much are you spending? How quickly are you burning? How quickly are you spending it? And I think what's really important is they're going to take a close look kind of at your kind of community and community growth and engagement rate. And are you a brand that's really growing on TikTok or Instagram that has the potential for national brand awareness? And that could be a combination of different factors or different ways to show that.
Okay, so then just a quick clarification question. In terms of LTV, for these purposes, are we looking at a period of a year or 6 months, or what is typically looked at?
Yeah, I will say every single company, and I worked at large corporate on brand portfolio growth strategy and billion-dollar brands, to I've been in the VC-backed landscape for over the last 15 years. Every single brand or company has done it a little differently. And when I've investors, in their models, they have their own way of calculating. Broadly speaking, I would say if you're doing LTV right, my opinion, my own, is that you should be doing it over a cohort period of 6 to 9 months and looking at it that way. For me, when I do it, I am looking at, I first segment by customer, because I don't want to look, you can look broadly, but what's most important is the core customer, the one you're going to continue to refine and target on, the one who is sort of the most important segment of your brand, your loyal customer. And I segment down to that cost of acquisition at LTV, because I think that's the foundational metric of the business. The broad, what investors, good investors know, and good operators know, when you're building a business the first 2 years, you may attract people who aren't really the profile of your long-term consumer. And there's going to be sways, ups and downs in revenue. There's going to be distortion to your numbers because you get churn from attracting the wrong person, or your product portfolio shifts and the business adjusts. So I think it's really important to conceptually understand the story you're telling investors. And the story I like to tell is, this is the core customer to the business. This is their LTV that we've seen. Typically, your recent metrics are the best over the last 6 to 9 months. And this was acquisition.
Okay, excellent. And then how much does the founder play into whether someone invests or not?
It's interesting because I've seen some $50 to $100 million brands in Sephora. You can dig in their website and you will not find the founder. It's really a corporate entity behind the brand. But right now in beauty, I do not think you can be successful without a strong founder. And when I say a strong founder, that's defined by multiple things. They have the right expertise to be considered credible. Their background, expertise, and story is intricately tied to the product's reason for being and the brand's reason for being.
Mm-hmm. I remember we talked about this and I couldn't agree more.
Yeah. And then they really are prepared to stay within business and invest the time required to be in front of retailers, to market it online, to manage the team, to be authentically involved in product and brand development for the next 5 to 10 years. And you may have a great founder with a great story, but the products don't really align with their story, or you never really see them show up where it's important, or they're not really committed to the business over time. But TBV is infamous for specifically saying one of their first metrics or the first criterion they look at is the founder. And I even had a conversation with the Ulta team over a year ago before the shift last fall. And the first question they asked me about the brand I was on at the time was founder story. They believe within Ulta, you need someone to deliver heart and soul, to talk about the brand. And retail is so critical to investors. It's really what's required.
Wow. It's all intertwined. That's awesome, because that's what we do, is like making sure the whole story aligns and the thread is consistent throughout the target customer, the founder, the story, the positioning, the messaging. Like, it just makes sense. It's not like, it's not disjointed. And I think that's incredibly important.
100%.
Okay. So what are some of the biggest mistakes you see founders make when they're starting to talk to investors?
Yeah, I see so many founders sort of start with their classic story they use for consumers, which is their brand story and why they love the products and why the products are so good. And that's not the language of investors. Investors are looking at this as a business. Product and brand is just one piece. You need to be talking to them about what category are you in? Within that category, what is your core differentiation? How much capital have you raised? How are you using that capital efficiently? And what's your long-term vision and your plan for fundraising and growth? And then get into kind of the business metrics and performance. You definitely want to show they care, because it's a driver of business success. They care about quality crafted products. They care about a beautiful, authentic, consistent brand story tied to the founder. They're going to be watching you and your persona, because most likely you as the founder are presenting. But I've seen so many eyes glaze over if you start straight on brand and product and not get into the heart of the business.
Wow. Yeah, that makes total sense. And when founders are thinking about what they need to raise, what are some recommendations that you have in terms of what that number is?
So interesting, because I think that is a fluid sort of dynamic answer, if you will. Like 5-10 years ago, it would have been different. I had the guilt, people used to call them the guilt girls. And I remember I was actually in second year retail when they launched their business. So we were like some of their early testers. But I remember the story that they got a significant seed round on a presentation alone concept. That would never happen these days. Like, the world has really shifted. So I think my advice today, if you are a founder building a beauty lifestyle brand, D2C first, then ideally you're bootstrapping to about a 1 to 1.5 million significant seed round. And they will be looking for your sales and specifically the growth number. They're going to be looking at your community growth on Instagram and or TikTok. They're going to be looking at your margin and how you've thought about gross and contribution margin gives enough future profitability to the business. And they're going to be looking about sort of how you're using capital, how efficient you are, indicators that you can build a profitable business. And when we get to kind of Series A, the rounds I've seen on that are in kind of the 3 million range. So it used to be, I remember the days you could do like a 350K seed round and then go to a Series A at like 1 to 2. And that really isn't what I'm seeing lately. And investors are expecting, therefore, more and more proof. It's a difficult position, I really think, to be in now. You're expected to do more with less in terms of bootstrapping and getting a raise. So I even was chatting with a celebrity earlier this year who's launching or planning to launch a hair care line next year and had secured verbal, at least, commitment from Sephora to launch with them, and had outlined a pretty significant seed, I think, as a celebrity and for hair care, which is a large product assortment, could do this, about a 3 million seed, and had not raised it yet. And that's a very short timeline to launching in Sephora next spring. So it's a difficult environment for everyone. But that's how I would be thinking about it. If I am looking, I would start by thinking about, I want to get a 1 to 1.5 million seed. I'm going to need to show double-digit month-on-month sales growth. I'm going to need to show that I built in good gross margin to my product, and I'm going to need to show traction and community growth.
And is there a minimum that you need to grow the business to in order to, like, I understand like the double-digit growth, right? But there's probably sort of like a baseline where like we need to get to this point to even be considered.
Yeah, I would say, especially if you're talking about VCs, you need to have a $1 million in sales to be interesting to them.
Okay, got it. And then we're talking about Sephora and having a potential contract with Sephora. So let's say a brand gets a contract with Sephora, they get their PO, and they use that to leverage that to draw in investors. And then what happens if the deal falls through? Like, let's say they do get investment and then the Sephora deal falls through. What happens then?
So the good news, at least my understanding, if you've closed the round, it's not conditional on the contract going through. If you close the round, the investors did their due diligence on where you were as a business. You probably had a contract, because a lot of them will want a signed contract if you haven't yet gone into retail. Then it's the normal course of business reality. Things happen. Products fail or have PR issues. Retailers pull back. Tariffs happen. Investors know there's ups and downs. So I would say it's less of an issue in terms of risking the cash. It's more of an issue in terms of maintaining the business, because what you risk then is, how do you fuel that growth that you will need to make your investors happy, not get you kicked out as CEO or founder over the next year or two without retail? That will be the question you're asking yourself. How do I continue to drive growth? And it might be, do I focus on other channels? Do I expand what I'm doing in D2C? Do I look at an alternative channel? Can we accelerate R&D and product development and launch something new? But how am I going to be fueling that month-on-month growth without the retail?
And how quickly do they want to see results coming in? Immediately?
Investors, yeah. So there are quarterly board meetings, and I will say some early stage investors have regular calls with the CEO and founders. When you bring on investors for an early stage round, a seed Series A, they are normally thinking that they've given you 18 months is typical, year and a half runway until the next round. So I've seen investors walk in the door post round and say, let's map out now, what are we targeting for the story to be in 18 months, which is, what is the business performance? What are we making in sales? What's the growth rate? What does our profitability improvements look like? How will the capital been used? And then how are we setting up long-term success for the business, investment in R&D or product portfolio growth, that we can show them in for the next round? If you've done a Series B, if you've done a Series A, and you start right away your next board meeting tracking towards, are we setting ourselves up for that next round well?
Right. Okay. Fascinating.
Great investors know, great early stage investors know that a lot of founders, number one, aren't perfect CEOs. And even the perfect CEO with 20, 30 years of experience running companies, has strengths and weaknesses. And so they understand you may need to round out your expertise on your team, or you're strong here. Good ones will be supportive, will give you coaching or support as you need, will understand you may need to bolster up supply chain expertise or financial expertise or whatever it may be. They're not expecting you to do it all or know it all.
All right. So tell me from your experience, when you look at brands, especially kind of more recently that have had success, that have successfully exited, what sort of patterns do you see in their product strategy, retail strategy, DTC strategy, or content strategy even?
Yeah, I think so. I will outline that. And I think the question will be, will these trends continue? Will ever outline be where investments go 2 years down the road, 4 years down the road? So recently, there's been two major trends, and I actually might highlight three companies because I think they all represent something interesting over the last set of years. So Medik8 is a recent investment of L'Oreal. I mentioned them earlier. They are definitely a clinical and science-backed brand. They have a hero product, their crystal retinol, that's supposed to deliver, I think it's 11 times better results. And they started, like I said earlier, in the professional channel and then expanded into specialty beauty. I think it was Space NK. They came out of UK and Europe. But they, I think, had lower sales when they were acquired. I think it was under 100 million when they were valued, but it was $1 billion, reported to be $1 billion sale, so really high multiple. But that is definitely an example where L'Oreal was valuing the IP of the retinol technology and the scientists, the scientific team they would acquire and bring into their R&D alongside buffing up, or I guess bolstering up, their professional channel. Then you have Rhode, which is such a classic beauty lifestyle example where an influencer with a really wide audience, very high number, with already an authentic story about skincare and glazing, managed to build a great team around here, very refined product strategy, and a lot of loyalty and retention for her high valuation, which was I think the sale was in the $1 billion range as well. It's hard to replicate that. Unfortunately, not many. That really is a very unusual example of a celebrity with a really high following who had the authenticity and kind of built every element really well. And then Aesop, I actually think is really interesting. And I loved watching that because you asked earlier, do you have to do retail or is that the only strategy? Their own store approach was actually core to their strategy. So a natural brand that actually spanned categories. It goes from bath and body, men's, women. It really had a very broad product assortment. They did diversify into department stores, the Nordstrom and before closure, like Saks of the world, but own strategy, own stores was at their core.
100%. I saw their stores from the get-go. I mean, especially like it was very obvious that was a focus, a core focus.
Yeah. So I think all of those patterns have the potential to be replicated. It's just unless you are a biotech company or a scientist or a dermatologist, it's hard to replicate Medik8, but those in that world can. And then I would say if you're a founder and you're not of the profile of Hailey Bieber, then I think you really need to be thinking about your influencer partnership strategy very carefully and finding a way to stand out uniquely on TikTok and Instagram. And then in terms of Aesop and the own store, I am very curious if if there's going to be brands popping up out of Roblox or from live streaming, the new world of shopping, if we're going to get some wins there and it's going to be a different world sort of 5 to 10 years from now. But that's what we're seeing. I think what's near and dear to my heart, and it could be because the founder profile is similar to mine, so I feel a lot of affinity for her, but Vicky from Tatcha, she was Wellesley and then HBS just a year above me. We crossed paths lightly. But watching her go the classic brand management path and then bootstrapped, build it out of her parents' garage, I believe, And I think she bootstrapped for a couple of years until her first round.
I think more than a couple of years, actually. I think it was, because I remember doing a profile on her a little bit ago. I think it was a few years for sure.
But then I think what's really interesting is that a lot of people talk about the partnership she had with a luxury department store out of the gate, like her first year, which kudos to her. But when I saw her business in the early years, I think my guess would be the crux of her sales and her brand awareness came from going on QVC. She personally went, her story was a big portion of her business the early days. So when you think about 10 years ago, where the average woman in her 40s or 50s was buying skincare or watching such a huge audience, such a huge, easy capacity to get brand awareness, to be able to tell your story authentically over a period of time. And I do really see, again, like live streaming TikTok video as kind of a next gen QVC HSN for the new generation, really waiting for one of those platforms to deliver a brand that can get to 30 to 50 million without retail.
Very cool. Love that. And then for those who may not want to go the traditional route, what are some of the other financing options? Obviously, you mentioned family funds. Anything else that you can share in terms of options?
Yeah, I've seen a couple interesting alternatives. I would highlight one especially. If you are either looking to maintain your business, keep it private, just looking for that 5 or 10 or 20 million business that you can own, there are new companies popping up that if you've proven some success on e-commerce, have some steady sales, good margin, and have literally a contract with a retailer. Again, they love these signed contracts. They will finance the PO. It's PO financing. They will finance basically the huge capital outlay, which is traditionally inventory. So you're not getting everything financed, but they will finance the PO and take that bulk of it and provide you capital for that, which is a really interesting way if you're able still to manage a lot of the marketing costs that come.
Yeah, I've seen those too.
Yeah. And then there's, again, this would be more if you're looking to keep it private and are comfortable with this steady reduction to your top line or to your profitability. But there are some new companies that help finance D2C and e-commerce, whereby they basically, once they see you've hit 1 million or 5 million really well, they will help fuel product development, team expansion, wherever you want to allocate the money. But they basically then take a steady percentage of sales off the top line. But there's, I will say the landscape is hit or miss. There's definitely due diligence required if you're going to partner with someone, but there's some really good outlets that have helped e-com companies get up to 50 million without the VC route.
Cool. Very interesting. All right. So last question, Dominique, and of course, I'm, if you have any other additional thoughts you want to share, please do. But is there sort of one piece of advice you wish every founder knew before thinking about and then taking and talking to investors?
I will just repeat what I said earlier. Finding the right investors, if that's your goal, is like dating. And if you're looking to marry a set of investors, start early. It's about timing, and it takes time to find that. So don't wait until you need money or you want to start your round to begin that process. You should be starting to date investors from day one.
Okay, great advice. And anything else that I didn't ask you that I should have asked you?
It's more concerns me that we get swept up by the cover of Inc. magazine or being profiled in Beauty Independent. And we all want, which would be amazing, TrueView Ventures to back us and us to have a beautiful exit. But that is a high risk, high reward path. So few make it. Doesn't mean you shouldn't do it if that's your goal. But I really would encourage all entrepreneurs to be really thoughtful in the early days, really think carefully about the kind of business they want to build, what will make them happy 5 to 10 years from now. We've seen amazing brands follow that path and succeed, like Becca Cosmetics, and then get closed a few years later because within the Estee Lauder machine, they just weren't allocating, in my opinion, the right investment and talent to what is a small fish within their larger portfolio. So maintaining a brand is important, or maybe it's just cash. I think I wouldn't discount building what some call a lifestyle business, which in some worlds has a derogatory aura to it. But I think that's a beautiful thing if it meets your goals And you should really consider the different avenues to build a business and then design and architect your business, your investment strategy, your allocation of capital against what kind of business you want to build. I think too many just assume we do this or that's the only way, and it isn't. And it won't necessarily make you happy. So
I love that you shared that, because I actually love the lifestyle business model, especially for a lot of the women founders that I work with. I see it as a better fit for many of them. Sometimes I ask them, depending on where the conversation's going, like, are you looking to build a lifestyle business or are you looking to build an enterprise business? And a lot of times people haven't even thought about it, right? They're just kind of starting their building, but they're not thinking about, like you said, like, what type of business are you? What's the end goal? What type of business are you building? They look very different.
They do. And I understand it. When you're starting out a business, and if you haven't done it before, it's so much. Your hands are in so many pies. I'm sure thinking about where do you want it to be 5 to 10 years from now is overwhelming. But I love that you encourage them to do so. I think facilitating that conversation, which is something I always, no matter what founder comes to me, I always end up including that, because I think it's so important to carve out time and really think about why you're doing this and what is it. And we do that in life. We do that for our relationships. Why don't we do that if a business can be such a large percentage of your time for that part of your life? Yeah. And we've seen, I'm sure you saw Ame Cole, such a sad story, got retail, got a round, right? I think it was 3.1 she raised. And then 3 years later, money ran out, couldn't find the next round, closed. And she really banked on that very accelerated. Like I said, they typically expect you to raise again within 18 months, maybe 2 years. So I asked myself, if she had kept that business private and or managed it a different way, would it be a different story now? But obviously, I'm sure that was her goal, and she went into it with heart and soul, and it just wasn't the outcome she expected. Some way through no fault. It's a bad environment to be raising right now, but that is an outcome. And so,
yes, that's true. It is an option. It is an outcome. I think one thing to think about too is, you mentioned like high stakes, high reward, but also high pressure, and knowing yourself and understanding if you're somebody that thrives under high pressure, or if you want to take that slow and steady approach.
Yeah, I think you have to be prepared for, I basically, in the last 3 years, I exited my last VC-backed company end of last year. Definitely put my health, my doctor was telling me, at risk. It's intense. It's physically demanding. It's a lot of stress. It's exciting. It's challenging. At the time, I wanted to be on that ride, but I think, yes, 100%, you physically need to be prepared for a high intense, high stress, day-to-day lifestyle.
Definitely works for some people, maybe not be the right fit for others. So it's really important to ask yourself what that is for you. So Dominique, how can people find you? Where can they find you? Give us the information. How can they work with you?
So I currently work with investors and founders on this startup journey, and basically how to architect the brand business to be successful in terms of growth. So that is typically fundraising, thinking about restaging brands and products for retail, and all that good stuff. You can find me at artofcreation.co or reach out to me on LinkedIn and DM me, and happy to chat and discuss kind of anything you're thinking through or how you want to move the business forward. But artofcreation.co.
Amazing. Well, thank you, Dominique. This was so enlightening. I know our founders are going to love this session, and have a beautiful rest of the week. Thank you, everyone, for listening to this episode of the Beauty the Brand podcast. If you love this episode, please leave us a review. We appreciate every single one, and we'll see you on the next episode. Bye, everyone.
Thank you for having me.